Hey guys, let's talk about Disney. So Paul from Everything Money has decided to buy more Disney stock on the hopes that it's a value proposition for the future.
The whole negativity around Disney is huge. And full disclosure, I've been buying.
Is he right? Well, the company has just managed to end the writers' strike. It's said that it's going to quiet the noise around the culture wars, and it's planning to invest around $60 billion into its successful parks business. So the future seems relatively rosy for the company. It's also managed to turn some of its losses in the form of failed TV shows into tax write-offs, which add up to billions of dollars. So is this the time for a Disney turnaround? Is this the time when you should be buying Disney stock and potentially making out like a bandit in the future? Well, in my opinion, no. I still think that Disney is a value trap, and in this video, I'm going to tell you why. Let's start off by examining some of the so-called wins for Disney and starting off with the end of the writers' strike. So many have speculated that the writers' strike has actually ended with a win in negotiations for the studios. And even if that was the case, if Disney were to get a favorable deal with the writers, it's almost certain that they had to make at least a few concessions to them. So paying them more or giving them more expenses. That means that the expenses of creating new TV shows and films is going to increase from their already pretty bloated and gargantuan highs. So I personally don't view that as a win for Disney, as it leads to their costs being higher in the future. Secondly, let's talk about the $60 billion worth of investment into the parks business. Now, it was intended as a positive announcement, but the market actually took it pretty negatively, with the stock tanking around 3% after the announcement. Personally, I agree with the market here, as I don't think that Disney will have the capacity to open a new park even with $60 billion being spent. And without a new park being open, I doubt that the growth rate of the currently existing parks can increase to that much higher than the already pretty high 6% for perpetuity. In addition, park attendance is partly driven by interest in the company's franchises, which are at all-time lows in my opinion when you look at franchises like Star Wars or Marvel. So I think the company is kind of putting the cart before the horse here by investing into its parks rather than investing successfully into its franchises and then using the interest in that to drive more people going to its parks. Thirdly, the culture wars. Now, Disney has almost become a lightning rod when it comes to the culture wars, and the company has recently had a meeting where Bob Iger, the CEO, quoted that he wanted to quieten the noise when it came to Disney and the culture wars, i.e. to disinvolve the company from the wars and become less politicized. In my opinion, that is a smart move, as alienating 50% of your potential audience is not a wise one when you're a business who is meant to be making money for the shareholders. But I do think that the company has become so entangled in the culture wars that it's going to be almost impossible to get out. Just look at Bob Iger's predecessor, Bob Chapek, who was forced to make a humiliating apology effectively on TV by his employees, whereas in contrast, Reed Hastings at Netflix told his employees, if you don't like our content, then you can leave. So that really shows where the power's at the company Disney. I also doubt Bob Iger's sincerity when it comes to ending Disney's involvement in the culture wars, as it was effectively him that started it. He then kind of passed it off as his successor's Bob Chapek's problem and made him the scapegoat, but in reality, the culture wars at Disney started long before that. When he was reappointed as CEO about a year ago, he also made the exact same claim, saying that he wanted to quieten the noise around the culture wars. And look at all of the content that Disney has put out since then. Maybe he has a different idea of what the culture wars are, and he's just talking about the political involvement of the company, but it's pretty clear when it comes to the actual agenda of the company which side they're taking. Finally, you may have heard a lot of noise or lack of noise about various different TV shows being cancelled from the Disney Plus streaming platform recently. And if so, that's because it's one of Disney's last big wins. It managed to claim back around $1.5 billion worth of tax write-offs by cancelling and destroying the content on old shows for things like Willow and other TV shows that didn't do so well. Now, this might seem like a win with $1.5 billion basically going straight to the shareholder, but in my opinion, it speaks a lot about the quality of writers at Disney and how they've actually managed to spend so much money on poorly written and designed content. You see some of its rivals doing the same thing, but the big winner of the streaming wars, Netflix, has done no such thing. It hasn't written off any of its shows, and I do think that it's a sign of desperation of the company desperately needing cash flow. And the reason it needs cash flow is because
our parent company Comcast owns 33% of Hulu and has entered into a deal with Disney that will eventually mean it sells that 33% stake. In 2024, Comcast will be able to sell its 33% stake in Hulu at a floor valuation for Hulu of $27.5 billion. Now, it could be higher.
the Hulu acquisition. Disney acquired Hulu back in 2019, during Bob Iger's first stint as CEO. The company paid around $18 billion for 2/3 of the shares, leaving 33% of the company owned by Comcast. And there was also a deal by Disney to buy the rest of Hulu from Comcast by the end of 2023. That's now been revised to a September the 30th date or deadline. And the minimum price Disney has to pay for Hulu around $9 billion. But Comcast are actually pushing for more. Disney has around $11 billion in the bank, so the acquisition of the rest of Hulu is basically going to wipe out its entire cash position. Obviously, the company can borrow more money, but the company is already seriously in debt after making so many acquisitions over the last decade. So Disney is basically cash strapped, and it does make the sale of various assets at Disney more likely. Bob Iger has even gone on the record as saying many parts of the business aren't core to Disney, and it seems like he'd be open to selling them.
Let me ask you about it. We're talking, I guess, ABC, the network, the stations, but then the cable networks as well.
Yes, correct.
FX, Nat Geo. Is it possible you would look to sell them?
We're going to be expansive. I think if you can interpret what that word means. You know, we're just getting at that work, but we have to be open-minded and objective about the future of those businesses. Yes.
Meaning that they're not core to Disney?
That they may not be core to Disney. Yeah.
With the company basically being forced to pay a dividend by activist investor Nelson Peltz by the end of this year, and having to spend $6 billion per year on its parks business, you have to wonder where all of this money is going to come from. Just look at the company's pre-COVID, if you want to take that measure, free cash flow. It was around $6 billion per year. So even if the company was to recover their free cash flow to those levels, it would basically just about break even on the infrastructure spend on its parks. As I've discussed in previous videos, Disney is struggling to actually get more subscribers for Disney Plus, and it's resorting to giving discounts on your first few months if you subscribe to Disney Plus, something that Netflix hasn't done in years. Netflix is busy raising their prices and getting more customers, whilst Disney is losing customers and lowering their prices. It really almost looks like an act of desperation by Disney to get more subscribers. I think the pivot from Disney Plus, which was meant to be the savior of Disney, into the parks business is almost a tacit admission that Disney Plus is a bit of a failure. So Paul from Everything Money's entire thesis on Disney relies on the fact that he's hoping that the company can easily recover to pre-COVID levels of profits and free cash flows. But I personally think that that's simply not possible, with the company having transitioned from being a legacy cable provider to effectively now being a streaming company. And with streaming competition extremely wild, and it actually being an unsuccessful streaming company in my opinion, I don't think that the future is bright for Disney, and I think that any turnaround may be years in the making. So I think there's plenty of better stocks out there to buy in the meantime. So let me know guys what you think about Disney as a stock in the comments below, whether you think it's turned the corner on its recent financial woes. I'm really interested to hear what you guys think. If you did make it this far, please leave me a like and subscribe, and I'll see you guys next time.